Good morning, all, and welcome. I think the whole idea of today's session is to considering the way global markets have a turmoil and how we should plan keeping that into the mind. So, I think the most important part today as an investor, what we have seen, I think most important thing is how we do the asset allocation. And today's session is not about just as a learning. Idea is that how we make a decision on global investing so that it can impact your wealth from a long term perspective. And one of the reason, if you look at I think every Indian investor today should accept that how investing only in India is impacting the overall wealth creation. I think the most important part, I think the way currency has depreciated. So if you look at INR has depreciated almost 65% versus USD over 20 years. So technically every year you end up losing 3 to 4% return because of currency if you are investing on the global side. Secondly, India is only 1.5% of a global market cap, which means lot of opportunities which are there from an investing perspective today we are not able to capitalize. And if you look at in terms of the return perspective, global markets, especially if you look at US markets and some of the other markets, are able to give equivalent return or a better return compared to Nifty in the USD term. But the most important thing, I think that's the one thing which most of the time we miss. We just look at the return part but not the volatility part, because I think if you look at on the risk adjusted basis, it has done better. And if I look at the Nasdaq return, it has done better than even with Nifty. So I think the most important thing, if you look at from an investing perspective, there's a real low correlation and it give a diversification. So if you look at India and US, it's a 0.55% overall correlation, which reduce significant portfolio volatility. I think today one of the biggest mistake what most of the investors do, they have all investments into a one basket. I think that is what we have to look at, that this is not a diversification, because end of the day if all the investments are kept into a one market, then it is not a true diversification. So overall or ideal allocation, what we are now suggesting on the allocation perspective, that in a phased manner we should look at to increase the global allocation, and it should move between 20 to 35% depending upon what is the overall requirement from a goal perspective and future investment perspective. Because today I think it become very critical as an investor perspective. Why global investing? I think the home bias trap. I think most of the investors always look at that. Yes, Indian markets is easy to understand, it makes sense to look at, but I think the most important part, if you look at last 4 to 5 years, the major part of rally which came into AI, cloud, biotech, many mega cycle, which if you look at Indian market missed completely, because these stocks are today not available in the Indian market perspective. And that's where it make a lot of sense. Secondly, if you look at the way regulatory change which is happening, where they're not allowing the investors, Indian investor, if you look at through MF side, a lot of restrictions are coming up where they're putting the limit. So that perspective also it make a lot of sense that you plan on a phased manner perspective, because we don't know tomorrow how things are going to change. And if you look at the overall global market cap perspective, today US is a predominant larger market, where almost 63% of the market cap, global market cap US, Europe 10%, UK 3.8%, Japan 5%, China 3%, and if you look at India is 1.5%. So if you look at on the overall perspective, we are at a much lower pace. And if you look at the overall market cap, US is almost like a 48 trillion market cap, where India is if you look at hardly 1.15 trillion. So the overall market cap perspective also, we are a very small in size in terms of the global opportunity perspective. And it's always makes sense that to look at and ask ourselves as a question that are we really doing a global investing? Tarak, can we have a poll in terms of to just to get a sense in terms of what is the overall outlook and how people have done investments as of now? because this will give a fair idea in terms of how we should look at, because many times we think yes, we have done allocation in the global part, but what is the overall percentage on the global net worth, because that is something which is going to be the deciding factor that how your overall investment returns and portfolio volatility going to be. I think as expected, almost more than 50% still not started allocation on the global side, and hardly 5% have more than 20% allocation on the global side, which clearly shows that today as the investors are not able to do a proper asset allocation, and there is a need that we have to work on that. Otherwise the same thing is going to happen even after 10 years, because it's always that thing come, if we have not taken action today, it's going to impact tomorrow. So I think it's a good to see overall result that I think the topic what we kept is in line as per the requirement, where still 55% have not done the allocation on the global side, 18% have less than 10%, 23% 10 to 20%, and only more than 20% allocation on the global is only 5%. So I think that's the whole idea, that to show the overall picture that why it become critical today. And I think the biggest factor, if you look at, I think the way currency is depreciating, so on an average 3 to 4% we have seen annual depreciation. So technically even as an investor who is making a lower return on the dollar terms perspective, still if you look at, because of the currency, he can see 18 to 20% return if somebody is just getting a 12% USD return. So that's make a huge difference on a overall longer term perspective. And secondly, it's always work as a hedge. So even 20% global allocation, I think it can reduce portfolio overall drag by 60 to 80 basis on a overall perspective. And now we will look at from a return perspective, because as an investor, end of the day, everybody wants to look at why I should look at global when I am able to have a good return in India. But surprisingly, if you look at if I look at Nasdaq, it has done better than Nifty, but for a comparison perspective, we have kept it only the well diversified index, not the only the technology index. So if you look at S&P 500, even has given 11% in USD, but if I look at post currency impact, it is better than Nifty. And the most important thing, it is non-correlated, 50.55%, it's non-correlated. So that's a one thing why we are suggesting that it is not, we are suggesting that move everything to the global. Our thing is that the blended portfolio which will reduce the overall market volatility. So if you look at, if somebody have a 60-40 60% India and 40% global, it can have a similar return but 25% lesser volatility. I think that is what is called the diversification dividend, and this is something which we are suggesting, because we have seen historically also that even in 2008 where Nifty has saw 60% drawdown, S&P 500 recovered 3 years faster due to structural US corporate earnings. So many times even markets are doing good India perspective, but they have their own structural issues, like for example India perspective, you have the government policy impact, or even the way the overall industry level changes which are happening and the sectors which are available. So it gives a complete comfort from an investing perspective. And if you look at return across geographies perspective, you can see that most of the markets have worked differently in a short period to long period perspective. So if you look at last 3-year perspective, where India has given 8.7% return, where if you look at all other markets did very well on an overall basis. So if you look at Europe, if you look at US, Nasdaq, if you look at 27%, so which is almost like a more than 3 times return. If you look at Taiwan, or if you look at South Korea, Japan, so if you look at majority of the markets have outperformed India. But same thing if you look at in a longer period of a time, India is in a same sort of a scenario. So idea is that not to just suggest that put it everything global, but in a different time period different market do better, so it add value in terms of the overall diversification perspective. But I think the most important part is that set the right return expectation, because that's a one thing many a time investor do a mistake. Like for example, last 1 year South Korea market did phenomenally well. They have moved up almost like a 60 to 70% in last 1 year. So people start looking at that this will be the my overall return on a future perspective, but that's not the way market works. So that's a one reason we should look at what is the overall 5 year rolling return, because that will give you the clear picture in terms of how we should expect the overall return. So there if you look at I think today in a dollar terms, if you look at S&P 500, it's far ahead compared to India, and Nasdaq if you look at it much higher side, because the most of the new technology innovation companies are there in the US market. So the most important thing I think, if you look at what we have to look at, how we are able to build portfolio which is very well diversified and non-correlated, and have the clear expectation of the return, because another thing which we have seen in the global side, Indian market at least is a very well diversified, and if you look at some of the market, like for example Korea, you look at there are only 2-3 company which hold 50 to 60% of the market cap, like Samsung and other things. Same way if you look at country like Brazil, where there are 2-3 companies which own the larger part of a market cap. So if you look at from the overall diversification perspective within a one market, I think India and US market always be on the higher side. But if you look at on a market cycle perspective, there are markets which do well, so those needs to be under allocated, not to go very high allocation into the market. Like for example Taiwan, if you look at semiconductor companies itself own 50 to 60% of the total market cap as a whole. And more than return, I think the one factor as right horizons which we always talk about, how it take care of the reducing the drawdown and reducing the risk, because that's the most important thing which many times as an investor we miss. We just look at the return part, but we don't look at the risk part, and that is something which we can see how the overall low correlation helps to reduce the drawdown. So there are times where like if you look at last 2 years, Indian markets have not done great, but same time US and other markets have done very well. So these type of non-correlated market help you to make sure that your overall returns beat the inflation, so that increase the overall return plus reduce the risk factor. And the most important thing, I think this slide I think is the one thing which always tell you that winners always rotate. So that is the reason why we have to diversify, why we should look at have a different set of a market. So if you look at last year, Korea did very well, 75% return, Brazil 34%, where India were at a lowest level. And if you look at 2024, US did very well on a comparative basis, where almost 23%, India 2.8. So if you look at last 2-3 years, 24, 25 and 26, we are the laggard. But if you look at the earlier years, we did well if you look at 21 and 22. So I think that is what as an investor we can learn. When India is doing very well as a whole, these are the time we should start looking at and diversified. Not if you ask me, it is not a time today that somebody should take out money from India and move to the other markets on a very high allocation perspective, but at least a fresh allocation they should look at and move it, because most of the time people do a mistake. The moment they see okay, this market is doing very well, they take out money from a market which is not doing good where it is doing good, and actually it works as a disaster for an investor, because market cycle change. So next year South Korea will not be in a top gainer, it will be at a bottom side so that's a one reason why we suggest that even if we are looking at to change the allocation, it has to be done in a phased manner. It has to be looked at from a goal perspective. We have to look at what are our overall needs and how we can do on a structural basis. And I think one of the major reason. If you look at from a valuation perspective, also that India always be on higher valuation because of the growth factor and the overall liquidity factor. And today also, if you look at, we are around 20p if you look at on the overall trailing perspective post correction, but still we are on the expensive side. So we are around at a long term average perspective. So that way, yes, we are not expensive today, but I think we are not undervalued also. So the idea is that as whenever our markets are trading on a very high premium, those are the times where we should look at looking at global. So in our view, today, if you look at on compared to the long term averages, India is not expensive, so we should not go very aggressively. But starting from a fresh allocation perspective, we should look at to increase the global allocation, because that's the most important part which we should look at. And secondly, our idea is that how diversification help to increase the volatility, because that is what we are trying to do as a part of overall thing, which includes, one is the global allocation, secondly adding commodities also as a part of the allocation. So if you look at gold and India, if you look at Nifty and gold, there is a 0.1 correlation, which means most of the times, 90% of the time, both will be working, returns will be in a different zone. So that helps to reduce the overall portfolio risk. So how as an investor you should plan asset allocation, because I think that's a always question come. Okay, everything is good, somebody will tell equity is good, somebody will say gold is good, somebody will say global will do good. But as an investor, how you should plan your allocation, because I think that is the one thing which become very critical, because that is what is going to make a difference. So we always believe that it should be based on the risk profile, how you should plan, and we should plan allocation accordingly. So core equity should be 40 to 60%. Somebody as a aggressive can look at some of the sector funds, then fixed income, gold and commodities, and alternatives. So it should be a combination of approach, and always we should look at what is overall our risk profile. So that's a one thing what we have seen over a period of a time. Most of the investor just look at what somebody else has done as an investment, and that is the one thing which impacts significantly, because when, for example, portfolio is down by 10% in a month, if you look at time like today, where last 1 month markets are down by 10%, a good seasonal investor, he will not exit, even if he does not have funds to deploy further, but he will not exit because he understands. But somebody who entered at the first time and who have a short term goal, he will come into the panic mode. So that's the one reason we always say that your investment should not depend on somebody else investment. It should be completely based on your risk profile, your goals, because that is what going to make a difference. And that's the one reason what we have seen, that the type of return what market has delivered and what investor have got a return, most of the time it is 50 to 60% lower than what markets have given the return, because investors end up exiting at a wrong time and they enter at the peak of the market. I think that is the most important thing. So what we suggest that based on the profile, be it a conservative, balanced and aggressive, you can do a combination of allocation on the equity, global, debt, gold and alternatives, because that is the one thing which is going to help as an investor. And how as an Indian investor can access to the global market, I think there are multiple way, and I think the most important thing which we have to look at and ask ourselves also, why we should look at the global market as a whole. Because one question always come, that when we are doing a investing, will you put 100% of your money into one particular stock? That if you ask me, there will be no investor who will put everything into a one stock. So when we are not going to put the whole 100% into a one stock, then how we can have 100% into a single country? I think that's a one question as an investor should ask himself, that this is a time now we should look at and start planning it, because it is not about the return, it is about how you protect your downside risk. And if you look at global investing, is not something new what you are trying to do, because all these companies you are using on a day-to-day basis. So if you look at on the AI side, India is one of the highest user on the AI side. If you look at on the global side, if you look at like Apple phone, if you look at Microsoft Excel and all other, so if you look at on a day-to-day basis, we are using all the global products. When we are using them, then why we are not investing into those companies? And especially market like India, which is the biggest market for all these global companies, that itself shows that how they are going to get benefited if we invest into these companies, because it's always easier for someone to understand, but we always go into that home bias and we think that it will be a tough to invest, but technically it will not be, because we are using these companies, and we know what is the potential of these companies. I think that is what we should look at. And if you look at different ways perspective, I think uh, international mutual funds, ETF way, if you look at go through LRS, Gift City, and even for NRI they can invest directly through USD account. Also there's the DTA benefits available, so there are multiple ways which can be helpful, and Gift City is emerging a very strong way on overall level. But I think before we start on the global investing, the most important thing, we should know what are the risk factors, because just looking at one side, okay, high return, currency risk, but there are possibility where, for example, INR may strength, maybe for a shorter period of a time, may not be in a longer period of a time. Secondly, could be the regulatory risk. For example, the way the overall forex reserve in India is reducing, so RBI may put further restriction. So we should be aware. So I think now TCS limit has increased from 7 lakh to 10 lakh. I think that's a one thing. Secondly, the market volatility. So it is not that only Indian markets are correcting. Even if you look at global markets also can correct, and especially we are negative on the US market. So at this point of a time, we are not suggesting to go and allocate aggressively into the US market, because they are already run up, and the way US debt to GDP on the higher side, it may correct further. So in our view, I think emerging markets will do better, not just India. If you look at including China, Japan, Taiwan, South Korea, a lot of Brazil, a lot of South Africa, a lot of emerging markets will do well. I think that's a one thing. Secondly, in US market, if you look at, there is a concentration risk, because the top 7 is almost 30% of S&P 500, and if you look at for Nasdaq, it's almost like a 50 to 60%. So we have to make sure understand that risk factor also. So we always believe that whenever we are taking a decision, it should be measured, and it should be completely on overall understanding perspective. So we'll look at one of the case study, like if somebody has done a 1 crore of investment and in 10 year, how the overall portfolio would have grown if one is he has done very diversified, and somebody who has gone very aggressively only putting into the equity. So if you look at on the long term perspective, the person who has done everything in equity, there is a 13.5% return. But someone who has done a mix of 50% equity, 25% global, then debt plus gold, if you look at return wise, there is not much of difference. But the most important part, if you look at the drawdown and the volatility, I think that's a one thing which as an investor will able to see that why it become very critical. So if you look at portfolio B achieved 96% of the portfolio A return, but with 42% less maximum drawdown and 32% lower volatility. Because I think that's a one thing which is going to make a difference. So most of the time people think that if I diversified, I'll increase my return. So if you ask me, in a longer term, the returns will be between 12 to 15%, irrespective of which part of the world you invest. Because if you look at the long term EPS growth of Indian market, or if you look at US market, they are in that range. So there may be a short period where markets would have done good, but I think in a longer period of a time, 15%, and somebody who going high risk, it can go up to 20%, not beyond that. So return is not the part. I think the most important part is that how it reduce your risk, because that is what going to make a difference as your portfolio size become bigger. And secondly, especially when today most of our clients we have seen, they wants to go, their kids wants to go for higher study into the US or any other part of the world. So if you look at how the currency is going to impact their return. So that's the one reason it helps a lot if somebody have money in the dollar terms, so that technically he don't need to worry about the currency part, only just he has to look at the return part. At least his overall risk will come down significantly for US based expense. And secondly, today we have seen a lot of clients who want to settle in abroad, so in that perspective also it make a lot of sense that start keeping some part of your money on the global side, so that tomorrow when you settle in the global perspective, you always can plan better. And I think the most important part which I talked about, that I think majority of new side of a business, if you look at Nvidia, Microsoft, OpenAI, they're not in India. So if you look at AI capex is a big opportunity, biotech is a big thing where things are happening, a lot of global consumer brands which are not there, even on the space and defense stack. If you look at, so most of the companies which are there in India, they are not at, if you look at the leader in the industry, they are at a level 2 level 3 companies, so we are not able to get. And secondly, when a good company come for Indian market for listing, they are already overvalued, so as an investor they are not able to capitalize the growth of the early stage. And the last important part, if you look at, I think if you look at, like for example, Nestle or Siemens, which are available in India, but if you look at from a valuation perspective, they are trading in a global market almost 30 to 40% lower than in India. So their parent company is trading lower than the subsidiary. So that give a good opportunity as an investor, even if they are bullish on one particular company, because overall perspective it reduces your downside risk. And the most important part which everybody look at, what will be the my tax implication if I do global allocation. So I've just made it on a simple perspective. For example, somebody made $5,000 of a capital gain tax, capital gain. So in that case, if he's holding more than 24 months, tax will be 12.5%. So if you look at recently, government has simplified the tax structure, wherein the tax for Indian equity or global equity, it is same, only thing the time period different. So for Indian equity more than 12 months, and for global equity it is more than 24 months to be taxed at 12.5%. And for short term it will be as per the income slab. And if you look at dividend or interest income in US, there is a 25% withholding tax, and for which you will get a certificate and you can adjust with Indian tax perspective. Then there is a about 10 lakh of a fund transfer. If you look at, there is a 20% tax collection at a source. So this is not a tax, because many times people have a myth that if I am investing in a global market, I have to pay a tax as a upfront. So TCS is not a tax. It is only if you look at a way of a government where they don't want people go on a high side global allocation, so they collect as a tax at a source, but this can be adjusted again your tax liability, even you can give to your employer for tax reduction. But at least as an investor, what you should do, at least start in 10 lakh of allocation. Maybe at a family level you can do 20 lakh, husband and wife they can do 20 lakh of allocation, but start. It is not about how much you do, but the most important part, you should start. And in case of a gift city allocation, if you look at, tax are taken care at a source. So long term capital gain is 14.95, short term is 42.74, and dividend is 35% 88 for Indian investor perspective. So technically you are not end up paying higher tax, which normally people have a myth that if I invest globally I have to pay higher tax, I have to pay higher TCS, but that's not the case. Most of our clients who come as a NRI, and for especially UAE based NRI, we have seen it make a lot of sense investing in India through gift city route, because at least because in UAE there is no tax on the capital, dividend and rental income, so technically they end up able to save a lot of tax investing in India through gift city. And secondly, even NRE FD, if you look at almost 7% fully tax free for them, and gift city, and then there is no wealth tax or inherent tax or state duty, which make a lot of difference for them. So today if you look at, we are suggesting to look at India piece and the global piece using a combination of approach for the NRI clients, because that's the one thing we have seen compared to any other markets. Like for example, if somebody is in the US or Canada, they have a lot of restrictions. So that way, UA investors, for them, I think India is one of the best investment platform through which they can route their investment, and they can do well diversified. And I'll take a last part, I think Gift City, because most of the people who are wants to know how Gift City is going to make a difference. So if you look at Gift City, is technically is a separate part of India in terms of from a taxation perspective. So you don't need to do any tax reporting in India. There is no GST, STT or stamp duty for investment through Gift City. You don't need to do any tax reporting. So it's a completely different jurisdiction which is created within India at a global perspective, and which have a global currency level allocation. So I think if you look at India is trying to build Gift City similar the way Singapore, Dubai, a lot of Mauritius, all these global markets are there from an investment perspective, because it's a free trade zone with various tax incentive which make sure that investor can do fully convertible investment into multiple currencies. Then you have the tax benefit in terms of tax are taken care at a source. You don't end up paying Indian tax. So it is a global ecosystem which India is trying to build, and that is something which is going to be the way of future investing. If we look at, I think I would end my session with one thing, that when one country cannot hold your ambitions, don't keep your wealth in one country. I think that's a one thing as an investor needs to look at. I think India is a generational good growth story, but India is only 1.5% of the global market cap. So 98.5% of the global opportunity else where INR depreciation, valuation and concentration risk, these are the structural headwinds to India only portfolio. So even today we are very bullish on India from a valuation perspective, and we are saying that it's not a right time somebody take out money from Indian investor put into a global, but for whenever they see a valuation premium, or when from a longer term perspective, they should start looking at and structurally plan. So this is the time where you should start looking at. So even if you take action at a later, secondly, because there's about 10 lakh there's a TCS, so it's always makes sense that do it a small allocation every year. So over a period of a time it can become a larger pie. Even if you want to make global as your larger allocation, because of the restriction it is not possible to do every time in a one shot. So I think our plan is that 20 to 30% should be a global allocation, and I think which normally say that best time to diversify globally was 10 years ago, and today is the second best time. And that's the one thing which we always tell, that don't delay, because this is going to be the way of investing in future, that we have to look at all the markets as a one place, and look at how we can reduce the risk, not the return part, because I think that's a way as RH we believe that always look at the risk adjusted return, not just as investing, and we can help you on the global investing part on a different options perspective.